A big move is coming to the stock market, and this is after a once in a lifetime rally. So, what exactly is this once in a lifetime rally? But more importantly, how can we make money? Because let's be honest, that's why we're here. We're following a simple 4-step recipe, and we will apply that to the charts we look at later in the show. But first, we want to understand how we got to a record close in August. It's because stocks are going up. Most stocks are going up. And that's why this once in a lifetime Wall Street rally raises a soft landing stakes. Yes, the stakes are high. So, whoa, whoa, whoa. Show me your supporting evidence. All right, Jerome, settle down. We're going to go through that right now. At the beginning of last week, Goldman Sachs told us that they expect new all-time highs this week. Well, we didn't quite get there. We got within roughly $2, but it's no cigar. So if these guys were expecting a new all-time high this week, what is going to change next week? Well, that's the really important question. We see a very positive 3-week equity trading window. So what could happen in the next 2 weeks, including last week, for stocks to go a lot higher? Well, first of all, on Wednesday, the Bank of Canada will report, and we're expecting a soft landing. Hey, Canada's not the USA, but we've cut first, and we're going to cut again. That's the expectation. What would that mean? Hey, we start a party, we hold hands, we sing Kumbaya, and we pet the unicorn. That never happens. That's the soft landing. And then on Friday, we got unemployment. This is going to be a good number, in my opinion. And then Apple next week. Presidential debate, CPI, ECB, and FOMC. Let me show you one quick chart and the reason why this is so important. If the soft landing narrative is going to continue, well, remember, the US is the best economy in the world. Canada, again, here we're looking at the S&P 60, already at a new all-time high record close on the monthly. Look at Germany and the DAX. They just had an election, but same thing. Biggest country over in Europe, right? The bellwether of the European economy. And they're going to be cutting rates on the 12th. Again, there's going to be a decision, sorry. But the US did not actually hit a new all-time high, which means that the July high has not got taken out. So if these other countries can rally, and now the odds of a soft landing have increased for the US, what could that mean? It means the US joins the party. They also go higher. Let's have a look here. Remember, good data is good. On Thursday, we're going to get ADP non-farm payroll, and we're going to be back at that 150,000 jobs. That's a really important threshold. On Friday, we're going to be getting official government numbers, 114 up to 163. Hey, that would be really good. Unemployment rate actually going down, and the average hourly earnings going up as well. So the average hourly earnings is not the good number, but remember, the Fed has 2 mandates. The first mandate is inflation, and yes, this number does not really help, but the Fed is more focused on their second mandate. That's unemployment. And with this number coming out on Friday, in my opinion, a lot of people are very worried about the SOM rule, which says that if unemployment rises by 0.5%, there is a 100% chance of a recession following shortly after. So is this going from 4.3 down to 4.2 going to alleviate that pressure from the SOM rule? Hey, that's why the stakes are high. That's exactly what I laid out at the intro of the show. If now we go further, we want to also understand that new leadership is emerging. The August gainers are not the winners of before. DAX is green in the month, right? The Canadian economy is green in the month. But a lot of big stocks like the MEGs are actually red. Semiconductors, right? The Russell, Bitcoin, Ether, VIX, 2-year note, 10-year note, dollar. Okay, what does all that mean? Remember, when the Fed cuts, we usually see big declines after. The majority of the declines in these bear markets occurred after the Fed's pivot. The really important word here being bear. Do you think we're in a bear market or are we in a bull market? That's a really important distinction, because when the Fed cuts during a bear market, -30, -50, -60, yeah, it kind of really matters. Now let's think about what could actually happen, or a soft landing. This is a unicorn. Like I said, it does not happen. But if we go from 4.3 down to 4.2, I think that's what people are going to be saying. We did it, guys. It's 1995. It's not 1999. That's what I think they're going to be saying, which means we're going to go mega big up. How much mega big up? From the all-time high break in 1995, we went higher by 220%. That's right, 220. And my template over here for the SPX is still playing out. We've hit my first target, or the Fibonacci extension, at roughly 5,600. The next number after that, 6,200. Are we going to get there? Hey, this will be important. I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up or subscribing to the channel. Thank you very much ahead of time. All right. My voice is getting a little bit sore now, so I'm going to try to push forward for the rest of the show here. Oh, really sore throat this weekend. Anyways, options point to a gain in the markets that's like a beach ball. This is that big move I talked about before. The S&P could go up by as much as 2.4% at the end of September. What would that mean? Well, it would mean that the S&P is going to be higher in new all-time highs. I took the monthly close at 563, times it by 1.024 to give me 577. Right now, I think the market is basically greasing the wheel, right? Just like my voice is getting a little bit tired. You can see us going sideways here. But remember, volume usually precedes price. What do we note here? Bullish volume. That's correct. And we have our second strongest daily close ever. The only day we closed higher was at the all-time high. So we're so close to getting there. We have to get to precisely 564.87, or basically $1.20 to get there. So 2.4%. Hey, that sounds pretty good. It's been a great year. Look at this last part here, though. Like a beach ball, right? What happens at a beach ball when it finally gets out of the water? It pops. The market keeps trading like a beach ball you're trying to hold underwater. It keeps grinding back, though. Every time we go down, right? Selling at times, equity index keep grinding back. Remember, if we look here to the stats we looked at going back to the beginning of the year, after 20 more all-time highs at the midpoint of the year, 80% chance we go higher, 6 or 10%. We've talked about this before. Same thing here for the market being higher by 10% at the midpoint of the year. 83% chance we're going to be higher, either 8 or 10%. That's the beach ball we just talked about. So if the market's going to go higher, like it could start now and go higher even more. Why? 80 or 83% chance we're higher, for basically 6 to 10% higher on average. We're back into greed. And remember, extreme fear is for buying. Extreme fear, extreme greed, extreme fear. Now we're into greed, which is the part where we might throttle up. And Jerome Powell might be laughing all the way to the bank. He might be the best banker ever. So let's have a look here and see exactly why. The second part of the soft landing is going to be inflation. Again, going back to their dual mandate. We'll have a look here. GDP revision came in at 3.0. The core PCE is at 2.6. Growth is above inflation. That is a soft landing. That's exactly what Jerome Powell wants. So if now growth is above inflation and unemployment's going down, what does that mean? It means we might be going mega big up. If we look here to the third quarter, it's now revised to 2.53% as well. This is exactly what Jerome wants. But remember, it raises the soft landing stakes. The stakes are very high because we've had a mega rally. And this is where we really want to pay attention to the rest of the market. Earnings growth in the US is finally showing up outside of the mega caps, which basically means the S&P 493. If we look down here, we're focusing on the yellow line. This is the S&P excluding the Magnificent Seven, or the S&P 493. It went negative into 2023, and now finally it's going back to positive. We're expecting positive growth for the rest of the market. The NASDAQ is passing off the baton to the rest of the market. It's time to go up more. Look, healthcare, utilities, financials, New York Stock Exchange, RSP, S&P, XLG, that's the 50 biggest, gold, Germany, Dow, treasuries, regional banks, QQQ, equal weight technology, and the mega caps, all green. What's red? You can see it right here. Pause the video. So what this really means is that we need that baton passed, and we need to see other stocks emerge as leaders to really grind us higher. Because right now the S&P is being dragged up, but this drag from the NASDAQ is notable. Look, like we're not like that far off our all-time high, but there is a hole here. Germany's at all-time highs. Canada's at all-time highs. Why isn't the US at all-time highs? Exactly. That's my question. This is something else that's really important too. It's a measure of risk. On August 27th, we heard that the IPO hopefuls dilemma: cram into fall of this year, or wait for 2025. Some to test the market as U.S. election narrows available dates. So there's actually demand for IPOs now, which means the job is done, and now it's time to cut rates and sing the song we never get to do, right? Let's watch the unicorn and sing Kumbaya and hold hands. The U.S. is doing a lot better than China as well. China is seen missing growth targets for 2024. It's basically going down. It's trending down. So the U.S. is the best game in town. The U.S. is going to have big events. And there's a lot more stuff we're going to go through for the rest of the month. But really at high level, we just want to see how these three events play out and basically the reaction. The soft landing from Canada, the data point on Friday, and what the market's going to do in reaction. The Fed's going to be doing their meeting on the 18th. So to keep things really, really, really simple, we're just going to look at two charts here now. So we're going to look at the S&P, and I told you, this is the bear recipe. So the bears managed to do number one. They did not manage to do number two, which means the bears are now reset, and they have to go back through these same 4 steps. They have to print a lower low, which means getting below 510. Then they got to close this below there. Then they got to print a second red month, and then they got to continue to move lower. Look, 2 red months, bear market. 2 red months, correction. 1 red month, no correction. 2 red months, correction. Sorry, that's not a correction, is it? Let me double check. That's a drop of 10%. That's a correction. 2 red months, that's a bear market. That's 20%. 2 red months, we start to go sideways to down. Are you noticing the pattern? 1 red month is not enough. And we don't even have a red month. We have green months. We're at record closing basis. So the bulls are in full control. This is what I'm really focused on here going into the rest of the month. 563.18 is last month's high, which means that we have a failed breakdown or a bottoming pattern, and 3 closes over the previous candle highs. That's an expansion signal. Why is this particularly important? Well, I just told you about these dates. So now let's think about this. If the rally is going to continue, we cannot afford to print a weekly lower low. That'd be going down below 555. And we basically want to close above the previous candle high one more time. That's going to be right here at 565. All right, that's it for today's video. Watch the one on the left or subscribe on the right. Thanks so much for tuning in.